Good evening and welcome to another episode of the Weekly Market Wrap. My name is Daniel Ang, and today, of course, is the first weekend of December. And it has been a very quiet week. I think this could be possibly the calm before the storm as we go into the Fed interest rate decision on Thursday, which is upcoming Thursday. So just be aware that the market could be explosive going into that decision. Okay, so before we go into what may happen, let's do a recap of what the market has been doing for the past week. Now, before we get into the content proper, let me remind you that this presentation is not an offer to buy or sell any kind of securities, be it FX, CFDs, or even cryptocurrencies. So just be aware that the trading of any kind of margin products do carry the element of risk. So before you attempt to trade any kind of margin financial instruments, be aware of your own risk profile before you proceed. And I'll be sharing with you my views of the various market as we go along. Just know that this will be my personal opinions and does not constitute an investment advice. And I shall not be responsible for whatever that you may be doing right after this presentation. Now, the content of this presentation has not been vetted by any regulatory body, including the Monetary Authority of Singapore, of which I am based. Okay, so right now, let's get into the content itself. Now, first, before we get into the economic data that has been released throughout the past week, let's get to know that the on the first day of December, the Federal Reserve has officially ended what we call quantitative tightening. Now, this is the exact opposite of quantitative easing, which is the pumping of liquidity into the marketplace. So basically, this is the legacy of the COVID lockdown in which the Federal Reserve injected massive amount of liquidity into the market to make sure that the market has enough liquidity during the lockdown. So this is what we call a after effect of that massive liquidity injection. So the Federal Reserve is trying to drain liquidity from the marketplace. And although it has ended quantitative tightening, it does not mean that it will be the return of quantitative easing, which a lot of commentators are basically saying that because we are ending quantitative tightening, the Federal Reserve may be looking at reversing his monetary policy by injecting liquidity into the marketplace. Now, that may still be the case, but however, we also knew that the Federal Reserve has, for all intent and purpose, has already injected quite a fair bit of liquidity into the marketplace going into December the 1st. So the marketplace is currently experiencing a little bit tightness in terms of liquidity. That's the reason why we also see the U.S. Treasuries and basically the Federal Reserve is looking at relaxing the reserve requirement for banks, and this seems to be a worldwide movement. Okay, whereby banks are no longer required to keep as much liquidity reserve in their balance sheet in an effort to actually inject liquidity in the marketplace and to encourage bank lending. Okay, so again, that has been a legacy of the 2008-2009 financial crisis, in which big to fail banks has actually needed the federal government to come in to basically bail them out. Okay, so right now, are we at a stage whereby we should not be lowering the reserve requirement for too big to fail banks just when we are at the crossroad in which a lot of things are coming to a what we call a perfect storm. Okay, I do believe going to 2026, we're going to see excessive or maybe even extreme volatility going forward, and the timing towards relaxing the bank reserve requirement may not necessarily be a good move, but I think the policymakers are basically now at their wits' end as to how to manage this runaway, how we call global national debt. And of course, we also see that the market right now is getting a little bit jittery about the high valuation in US equity markets in relation to the tech stocks. Okay, but I think the market has basically recovered back a big chunk of what we saw in terms of the surprise retracement in US equity markets. So there's a lot of things to digest going forward. But I think one thing is for sure, we're going to see a pickup in volatility going forward. The other thing that we want to also watch out for is actually, so let me check. There's a question here. Is that a is there somebody doing a question here? Okay, sorry. Now, what happened is that we also want to also be aware that not this coming week, but the week after. Another thing is that is going to cause market to gyrate. Okay, is that the Bank of Japan is considering raising interest rates. Now, this is coming on the back of the Federal Reserve looking to continue to cut interest rates. So there will be a monetary divergence between the two major central banks. One is cutting rates, the other one is looking to hike interest rates. So will that cause a market dislocation? I think the potential is basically there because the reason why the Bank of Japan is considering hiking interest rates is because the yield on the JGB, which is the Japanese government bonds, has been climbing to record highs for some of the durations, okay? Basically, the longer end of the yield curve, the 30 years and the 40 years, JGB has been climbing. So are the lower end of the yield curve. So that means if the Bank of Japan is going to hike interest rates, it will cause perhaps the unwinding of the yen carry trade. Now, remember 2, 3 years back, we saw what happens when the Japanese yen was exceedingly weak, and that caused the Bank of Japan and the Japan Finance Ministry to actually intervene in the currency market, and which also caused a unwinding of the yen carry trade. So are we going to be seeing the same thing again? Like I said, the potential is basically there. So this could be tectonic in the sense that where two major central banks are going in different direction. Now we all know very clear that the White House, the Trump White House, is desperate for lower interest rates, and they will do anything to get interest rate to come down. They have not been very successful in trying to get the Federal Reserve to cut interest rate aggressively. So we can see that the President Trump has been trying to influence the FOMC, which is the Federal Open Market Committee, in which they will vote for monetary policy. So President Trump has actually managed to insert his own people into the committee itself. And we are also looking towards the ending of term for the Fed chairman, Jerome Powell, which is not due until May. But I think there's a very high likelihood that President Trump will actually announce the name of his preferred replacement for the Fed chairmanship. And that will be between two individuals as far as we are concerned. Later on, I will be showing you who are the front runners that will be likely to be taking over the Federal Reserve when the Fed chairman term ends in May. Okay, but the fact is, once the name is announced, it will basically make the incumbent, which is Powell, role a lot more difficult because there will be two voices as far as monetary policy is concerned. So just know that this expected Bank of Japan's hiking of interest rates will not only impact the dollar versus the yen, which is currently trading a little bit lower because of the expectation of interest rate hike in Japan, and we will also impact the Japanese government bonds, which is currently trading, or rather, the yield is trading at near record high. Okay, and of course, it will also impact the Japanese equity markets. We saw a little bit of gyration in the Japanese Nikkei 225, but I think this week itself it ended positive. The other thing will be Bitcoin. We saw Bitcoin have a massive sell-off from its all-time high of 126,000 thereabout to as low as just marginally below 90,000. I believe the lower was 88,000. So this will also impact risky assets. So again, keep your eyes peeled if you are into those assets as well. Okay. Now, oil prices has been rising, which is a surprise because we all know that OPEC Plus, including Russia, has been increasing supplies of crude oil. But I think the 2% rise in crude oil prices is a result of uh, President Trump's announcing a complete closure of the airspace above Venezuela, and that leads to a lot of speculation that the U.S. is likely to move uh, on Venezuela militarily. Okay, and that will be a problem because Venezuela is the nation with the largest proven uh, reserve of crude oil. Okay, so this could be something to add on to the anxiety. Although crude oil is no shortage right now, but the worries that this will lead to a open conflict between the United States and Venezuela is definitely weighing on markets. Okay, so when we talk about oil rising 2%, it's talking about the U.S. West Texas Intermediate crude oil. Now we all know that the U.S. produce a lot of oil on their own. In fact, the U.S. is the largest oil exporter right now on the back of their shale oil, meaning to say that they manage to extract oil between layers of rocks, and they have perfected that technology. But whatever the US produce is the wrong kind of oil, because the West Texas Intermediate is a sweet crude oil, which is not something that the US refineries can process. The US refinery has always been buying oil from elsewhere to process, and those are the heavy crude oil with higher sulfur content. And Venezuela happened to be having those heavy crude. So that could be the reason why the US, or rather President Trump, has been on Venezuela case, trying to do a regime change by toppling the current president, which is Maduro. Okay, so to basically cause a regime change within Venezuela so that the US can install their own preferred regime so that they can get access to those crude oil. Okay, so that is basically what we are looking at in terms of the sudden spike in crude oil this past week. The other one is, this is a piece of news that you may also want to know. Okay, Federal, as you know, is the issuer of the USDT, which is a stable coin. And as we all know, the Genius Act mandate that all stablecoin issuers should back their stablecoin with US assets, namely US dollars or US Treasury. However, Federal is not uh, does not have its jurisdiction in the States. It has its jurisdiction in, of all places, El Salvador. Okay, and Tether, although they do hold US dollars and US treasuries, but they become of late the largest buyer of gold, to the point whereby they are even more aggressive than central banks. As of Q3, Tether has accumulated 26 tons of gold, okay, more than any central banks. So the fact that Tether is not accumulating more US dollar assets, instead buying gold, is actually problematic for the United States. Because if Federal, the largest stablecoin issuer, is not accumulating more US dollar assets and US Treasury by default, then it is telling the world that Federal believes that there is a major structural change going on, and they want to hold their reserve in gold rather than in US assets. So this tells us a lot. And it will also mean that Federal is on the wrong side of President Trump's preference. So it gets into the back book of the Trump administration, because they want all stablecoin to be backed by US treasuries, namely the US treasury bills, the short end of the US treasury bonds. Okay, so here we have a situation in which the largest issuer of stablecoin has decided to buy more gold rather than US assets. So this is something that we also need to be aware of, because at the end of the day, how the stablecoin narrative unfolds is going to be very, very interesting. Okay, we have already seen how Bitcoin is reacting, whether the Bitcoin treasury narrative is still going to be applicable, because we saw the largest Bitcoin treasuries a company called Strategy, okay, has seen its share price basically tank, okay, because Bitcoin has fallen quite a fair bit, although we did see a bit of a rebound this week, okay, but it is still basically it's still an open story out there whether Bitcoin's rebound is for real, or is it just simply some short covering. Okay. Now, this is the other thing that I was also linking to the stable coin. Federal now is on the wrong side of the Trump administration, and now we have S&P Global, which is a major rating agency, rating stable coin issued by Federal to be weak, which is the lowest rating given for digital assets. So here we have a major rating agencies rating Federal, which is the world's largest stablecoin issuer to being having weak rating purely because they are not 100% backed by US assets. So again, if you are into stablecoin and want to know what is going to likely to be happening in stablecoin, just know that the biggest issue of stablecoin now could be in the crosshair as far as the Trump administration is concerned. Now, Trump said that he has made up his choice on who will be the next U.S. Federal Reserve chairman. Okay, here we have two individuals here. A guy called Kevin Hassett, which is currently the director of the Council of Economic Council, and the other one is Stephen Miran, who is already currently sitting in the board of the Federal Open Market Committee, and he previously was the chairman of the Council of Economic Advisor. Okay, and he still holds that role. Okay, so basically between the two, both of them have something in common, in which they both advocate for very aggressive rate cuts to basically rein in the interest payment for the runaway US debt. We all knew that the amount of interest that the US federal government has to pay for their enormous amount of national debt, which currently at $38.2 trillion, is $1.2 trillion a year. And at the rate the US debt is accumulating, it would appear that it is out of control. And obviously, if interest rates do not come down, the amount of interest they have to pay on those debts is going to be very, very, very challenging. Okay, so there is that need to interest rate down to the bone. So regardless of who become the next Federal Reserve chairman, I think they will have to be in line with President Trump's desire to cut interest rate. Trump has actually mentioned 1%. He wants interest rate to come down to 1%, and currently it is at 4%. So there is a long way to go to cut. So if the next Fed chairman is going to be aggressively basically stirring the Federal Reserve into aggressively cutting interest rates, one thing will happen. That will be runaway inflation. So between a slowdown in the US economy and potential for hyperinflation, I think between the two evils, they decided that they want growth. So get ready for next year. Whoever is going to be running the Federal Reserve is likely to cut interest rates. So inflation be damned. I think inflation is definitely going to escalate. Okay, so you got to position yourself for very high interest rates into 2026 because lower interest. No, runaway inflation basically. Okay, so over time, if they actually cut interest rates to the bone, okay, we are likely to see runaway inflation. And the only way to tame inflation is to hike interest rates all over again. So maybe what they want to do is to cut interest rates, to lock in the low interest rates for the longer term treasury, like the 30 years. The 10 years and the 30 years this week has actually climbed again. Okay, so I think what they want to do is cut interest rates to lock in all the lower interest rate for the 10 years onwards treasuries. Okay, then when inflation become a real problem, then they will hike, okay, interest rates. So going forward, after the initial what I call that rate cuts, okay, which a lot of people will be uh, basically celebrating. Equity markets will be celebrating lower interest rates, but going forward into the future, okay, I personally will think that interest rate will have nowhere to go but to climb back up, okay, to tame a runaway inflation. So this is a concern. Now, the other one is that the world bond managers do not like this guy called Kevin Hassett, which is one of the two nominee likely to be the next Fed chairman. Okay, because low interest rate is not good. Okay, because if the Federal Reserve is supposed to be independent, now the new or rather the next Fed chairman is more likely to toe the Trump White House narrative. That means to say they are perceived to have lost their independence, and that will impact credibility. So bond managers worldwide do not like any of the two, okay? Whether it is Kevin Hassett or whether it is the other guy, what's his name? Let's see what his name. I completely forget. Okay, Stephen Miran, correct. Okay, so basically, the two candidates that are most likely to succeed Powell are definitely not the best as far as global bond managers are concerned. Okay, so they may actually drive the US treasuries downwards, which is already happening. Okay, so we are beginning to see yields on the treasury has been rising again. And then that means, conversely speaking, US bonds are falling. And if any of these two guys are actually going to be the one running the Federal Reserve going forward, then more unloading of US bonds is likely to be the case. So this is another risk going forward. Okay, so just be aware that the two candidates are not the best candidate as far as the market is concerned. Okay. Now, the first data set that came in was on Monday. We have the ISM manufacturing PMI, and this is the most current for November. We see there is a downtick for the manufacturing. It does not come as a surprise, but it was a little bit deeper than normal. The previous month, on October, we have 48.7, which is below 50, suggesting that the manufacturing continues to be in contraction. And consensus was for a marginal dip to 48.6. It came in at 48.2. So it was a lot weaker than the market expectation. But this is not surprising because the manufacturing sector has been in negative territory, or rather in contraction zone, since March of this year. Now, the other one, services PMI, refers to the service sector, which has actually improved, although the market was expecting a dip. Now, the previous number for October was 52.4. Market was expecting 52.1. Instead, it came in at 52.6. So all said and done, it seems that the service sector is still the one holding the US economy together. Okay, so this is being welcome. Okay, so we will have to continue to monitor going forward. Is the services sector the one responsible for the elevated inflation that the ordinary Americans are facing? I think that is the case because manufacturing has always been the engine of growth in the United States because it is a service-oriented economy compared to a manufacturing powerhouse. Okay, so here we have numbers that actually come in mixed. Okay, whether that will be taken into consideration by the Federal Reserve when they decide on interest rate decision next Thursday. Now, the other one is the ADP employment numbers. Again, we are not likely to see the missing data from the non-farm payroll for the last 2 months in which the federal government has shut down. So this is a private employment number, which is coming weak, very, very weak. We saw that the October number was creation of 42,000 jobs. Market were expecting a dip to 5,000 jobs creation, but it came in worse. It went negative 32,000 jobs. So based on this number alone, it reinforced the likelihood that the Federal Reserve will cut interest rates because the labor market appears to be the weakest link right now. Okay, if we have lower employment, that means the economy is slipping into recession. So, like I said earlier on, between trying to save the economy and trying to tame inflation, I think the White House is definitely leaning towards taming or rather trying to prevent a recession in the United States. Okay, because it is crucial because next year we're going to have the midterm election. So President Trump does not want to go into a midterm election with the risk of losing either any of the Congress, either it is the House of Representatives or whether it is the Senate. Okay, so I think it needs to save the economy to going into the midterm election. Okay, so there's a reason why they need to boost the economy by cutting interest rate to the bone, so that it can present uh, a, a, a healthy economic picture to voters going into next year election. But this private payroll is the biggest drop in 2.5 years. So based on this number, negative 32,000 jobs creation for the month of November, it is definitely not a good sign going forward. It shows that the economy is slipping into a recession. So perhaps the Federal Reserve will pick this number, and this is the only number that they have because they are missing data for October and September itself for the non-farm payroll. So we do not know what will be happening going forward. Okay. So this is the core personal consumption expenditure, which is the Federal Reserve preferred measurement of inflation domestically. So here we have core. Core means you take away the food and energy component on a month-over-month basis for the month of September. Now, remember, this is September. It's a very, very late data, may not necessarily impact the market. It comes in as stable at 0.2% month over month. For the year-over-year number, we see a slight dip from 2.9% to 2.8%. Okay, so this is a mixed data set because they cancel out each other, in my opinion. So remember, these are delayed data that we are only currently seeing in December for a September number. So don't give too much focus on this number because it's not that relevant anymore. Because what we want to see is the latest, not the delayed one. Okay, so the one that will cause the Federal Reserve to actually move our interest rate is actually the ADP employment change, which I've shown you just a while ago. Okay, so going into the consumer sentiments, we can see that sentiments for some reason is rebounding. Okay, U.S. consumer has not become totally despondent in the sense that they are not totally what we call it pessimistic about the economy purely because we saw the December number, which is the very latest number for the Michigan Consumer Sentiment Index, has actually rebounded from 51 to 53.3, even better than the consensus of 52. Okay, so this shows that US consumers are actually not that pessimistic. At least they are spending perhaps into the holiday season. So going into the holiday season, it tends to see a pickup in consumer spending. So this could be the result of that. We will only know whether the sentiment is able to hold going into the next few months, okay? Because this is a festive season, so this could be a holiday season inspired spending, okay? This is the one that we want to be looking at. We see that the US Treasury, despite expectation of a rate cut this coming week itself, yeah, bond prices are still falling. Okay, we still see that the yield on the 10 years Treasury has been climbing, and it is already highest since the bottom that we saw in April at just under 4%. So we can see that it is already climbing on expectation of further rate cuts, which shouldn't be the case because if you are expecting the Federal Reserve to actually step on the gas to actually cut interest rates, we should be seeing the exact opposite, okay, not what we are seeing currently. Okay, so the bond market is actually voting that they may not necessarily be confident that there will be further rate cuts beyond this month. Okay, the next FOMC meeting is not going to happen until almost the end of January. Then February, there's a break, followed by March, mid-March, there will be the next FOMC meeting. So market expectation based on the pricing of the US Treasury bond yields suggests that people, or rather traders, are not optimistic that we are going to get continuous rate cuts beyond this month. This month, market expectation is that the Federal Reserve is very likely to cut interest rate by another 25 basis points or 0.25% based on the ADP employment change number that which I just touched on earlier on. So will there be more rate cuts beyond, let's say, January of next year? I think the market has voted they don't think so. Okay, or rather they are not confident that will be the case. So this is where we are right now. The bond market is definitely voting with their feet. Okay, they don't believe that there will be continuous rate cuts, despite what the Fed chairman has, rather the market analyst has been telling us. So going into the coming week, there's only one highlight, which is the FOMC meeting, which is the Federal Open Market Committee, in which the Federal Reserve will decide on interest rates. Consensus right now is there will be a rate cut of 25 basis point or 0.25% to 3.75%. Now, this is not cast in stone yet, but I think the market is leaning towards another cut. Okay, although the Fed chairman has been telling us that this is not a done deal because he does not have a complete picture of the U.S. economy purely because of the 44 days lockdown, not lockdown, the 44 days shutdown in the U.S. government, leading to the fact that there was no data collection, so there were missing gap in data, so he cannot make an informed choice going into a major meeting, and the market expect him to further cut interest rates. Okay, so if the Federal Reserve does not cut interest rates on Thursday, the market is going to go it, okay? Because the market has already priced in the possibility of a rate cut this coming Thursday. So if the Fed decided not to cut, okay, all the calculation will be thrown out the window and there will be massive increase in volatility going forward. Okay, so whether the equity markets in the US and Wall Street will actually end the year on a very positive note, I think there's still technically the possibility that it can still happen, but next year is open season. Next year is totally there will be many things coming together to create a perfect storm. Okay, so even as the market goes into fresh all-time high, you just have to be very careful chasing this market ever higher. Okay, so I will be touching on the market itself now. Bear with me for a while when I go to my chart here. Now, if you have any question, don't be shy. Post your question into the chat group so that I can address them as they appear. Okay. So as far as the Dow Jones is concerned, we don't need to see the monthly time frame because this is just the beginning of a new month. We look into the weekly time frame. You can see that this past 2 weeks, okay, we saw a major rebound in US equity market. The Dow Jones has almost completely recovered back its initial loss from 48,456 down to 46,715. So this is as good as almost a full recovery. Of course, a break of 48,456, which is the all-time high, it's still very much a possibility because this market is in a long-term bull market. Now, for those who have been following me, I have always mentioned the fact that the US stock market is on a 16 years bull run from the bottom of March 2009, right after the global financial crisis. So this is a very old bull, but there is no sign that it is about to end just yet. For that matter, I think there always a possibility of fresh new all-time high, despite the poor fundamentals. Okay, so right now there is the issue whereby there is a lot of capital flight going into the Americas. So we can see that those capital that move into the United States has found their way into the equity markets. Okay, so this is the daily time frame. Okay, the market has done a very nice recovery from the low of 45,715 after the initial drop from 48,456. So the current high this Friday, or rather last Friday was 48,135. Not that far away from the all-time high, less than 200 points. So we can see that if the market extend higher, especially on the back of a cut in interest rate, it is still very possible for the Dow Jones to register fresh all-time high. Watch out for the market reaction on Thursday, depending on whether the Fed actually cut interest rates. Okay, so this is the Dow Jones. Let's take a look at the S&P 500, which is the retail end of the US stock market. Again, we see something very familiar. Okay, we can see that this low here was actually in the beginning of 2020, right after the COVID-19 low. So this has been on the weekly time frame, it has been a very established bull market. Okay, so now based on this market, we can see that the market is only barely a whisker away from the all-time high. Okay, the all-time high is 6,925. So we can see that this market is definitely attempting to break out of a fresh high. On the daily time frame, this is definitely the case. The highest traded this past week, let me see what's the level here. We have Okay, we have a marginal high for the week itself. We have a high here of 6,896. Okay, not that far from the all-time high of 6,925. Okay, so a break is very much foregone conclusion. The market is definitely gearing for a break of the all-time high. So whether or not this will be a fake move, meaning to say the market go out and take out this liquidity here and then starting to unravel. So again, be very careful chasing all-time high in this very mature bull market. Okay. Now, the one that you may want to pay attention to is the Nasdaq 100. Now, we all know that these past 2 years, everything is about high tech, everything is about AI. So the Nasdaq 100, which is the tech-heavy index on Wall Street, has been enjoying a outsized rally. Okay, the all-time high is 26,277, and again, very similar to the Dow and the S&P 500, we looks like to be on the verge of breaking into fresh all-time high again. Okay, so this is the weekly time frame, very bullish. And on the daily time frame, we can see that despite the three-way pullback, which ended a technical pullback, the market is on the rebound, and now we have a marginal high compared to 2 weeks ago. Okay, so you can see the market is definitely gunning for this high. And if the market do extend higher, the immediate target based on this method that I'm using is about 28,300 based on the Nasdaq 100 index. So overall, the Wall Street index basically are still very much in the bull phase of this long-term rally. Okay, so do not try to sell this index, any of this index just yet, because the market has recovered almost fully. Okay, in fact, based on the idea that there will be further rate cuts forward, the market is pricing in higher equity prices going forward. Now let's take a look at across the Atlantic and take a look at the European markets. Okay, here we have the weekly time frame for the German index. Now, German index is also rallying. Okay, this is a very mature bull market. Although the fundamentals are all wrong. Okay, Germany is one of the weakest economy in the G7 right now. Okay, but stock market continues to go higher. Okay, basically because Germany has retooled their economy, now it's stepping up to be looking more and more like a war economy. Okay, Germany has actually increased their budget for defense spending to 5%, and that means there's a lot of economic activity has been channeled into the production of weapons, and this is also the reason why the German stock market remains buoyant because of all this activity trying to build up their military. Going forward, like I say, going into 2026, all signs are pointing towards the possibility of the European trying to take over the lead from the United States as far as defense is concerned, and more likely to be getting involved directly with the war against Russia. So everything is pointing towards the possibility of the European, maybe not the whole of NATO, because US is not buying that narrative under President Trump. So if Trump actually pulls out, or rather take a step back in basically running NATO, then Germany is likely to be seen to be the one that will take over the baton. Okay, and if that's the case, I think all signs are pointing towards a direct conflict with Russia. Okay, so going forward into 2026, we have to prepare how to trade the markets if there's going to be a full-blown hostility between Russia and the whole of Western Europe. Okay, that is a real scenario which is likely to pan out going into 2026. So we have to make sure that we position ourselves for that possibility also. Okay. In the daily time frame, we are beginning to see right now the market has been going flat ever since the market hit an all-time high of just under 24,800. We saw a three-wave pullback to 22,900. Now there is a bounce back to as high as 24,500 again. So right now the market is neutral, okay, based on the daily time frame. But I think that possibility, especially if Wall Street continue to manage to break into new high, it may take the German index along for the ride. Okay, so everything looks bullish to me. So do not try to sell these equity markets either on either side of the Atlantic just yet. So when we look into the FTSE, which is the UK stock index, this is the UK stock index. It is very, very powerful. We can see that the low was traded in a COVID low, and the market has basically more than doubled. Okay, from 4,777 to 9,940 thereabout, and it does looks like the momentum is still very much in play for further highs going forward. Okay, now UK economy is definitely on the rope, but that is does not seem to affect the equity market performance. Now, on a technical basis, what we are seeing here from 9,939 looks like we have a pullback, but this pullback doesn't look complete to me. So, but I won't be surprised if we do see another dip below the most recent low at 9,425 towards a three-way pullback. Okay, I perhaps to even challenge the 9,274. It is still possible to see a revisit of the most recent low without damaging the long-term bullish outlook. Okay, so if there's going to be a pullback lower, that could be perhaps a buying opportunity. Okay, so once we have finished the German index and the British index, let's take a look in Asia. In Asia, of course, we will be looking into the Nikkei 225, which is the Japanese equity markets. Here we have the weekly time frame, very bullish. Okay, because the main thing that has happened since a new prime minister has been installed in Sanai Kataichi, she actually is in favor of stimulating the economy. They have already announced a $110 billion stimulus package, which has yet to pass their parliament. And if that's the case, we can expect equity markets to rally again because at the end of the day, any kind of stimulus package is definitely seen to be a positive for equity markets. Now, will that also cause uh, a dislocation because the Bank of Japan is actually looking to hike interest rates? So this will be going counter to the stimulus package that they have recently announced, because the Bank of Japan is more concerned about runaway runaway inflation. And to counter that, they are looking to hike interest rates. And when they hike interest rates with the stimulus package, who is going to come up with the money, or where is the money coming from to buy, to actually support this stimulus package? The Bank of Japan already said they do not want to buy any more JGBs. Okay, it means to say that if they actually high interest rates, Japan right now, the Bank of Japan actually holds more than 50% of the Japanese equity markets through their ETF. Okay, and that also include their pension fund, their insurance companies, and the Bank of Japan already said that they have no appetite to buy more. So if there's going to be a stimulus package, where is the money coming from? That is a big question. A lot of analysts are saying that the money could come from selling US Treasury. So if the Japanese ministry or the finance ministry decided that if they want to support the stimulus package, they may be forced to sell more US Treasury to raise the money to support the stimulus package. And that could be bad for the US bond market, which will see the yield on US Treasury continue to climb. We are already seeing that despite expectation of further interest rate cuts. So there's a lot of moving parts here. And the Japan decision to actually hike interest rates will come in on the 19th of this month, which is the week after. Okay, so we have to get through this coming week first on the 10th, where the Federal Reserve will decide on interest rate policy. Then the following week, we will have to consider the likelihood of Bank of Japan hiking interest rate, which basically will cancel out, in my opinion, the rate cuts by the Federal Reserve if it finally decides to cut interest rates on Thursday. Okay, so this is the outlook for the Nikkei 225, which is currently bullish. Okay, so on the daily time frame, we can see that we have a three-wave minor pullback, and if this is all that you can do, the market is getting ready to rally again. Okay, the all-time high is 52,661. Okay, so market is not that far away. Market closed on Friday at 50,616 something, 619. Okay, so it is not that far away. Okay, I think at the end of the day, the possibility of a fresh all-time high in the Nikkei 225 again cannot be ruled out, purely because of the possibility of the Japanese cabinet approving the stimulus package. Okay, so this is the outlook for Japan equity markets, and the other Asian markets that we may be looking at is the Hang Seng, which is the Hong Kong stock index. Okay, here we can see the Hong Kong market has been elevated. It is currently doing this a bounce from a low of 14,600. The highest traded is 27,424. So we can see that this is an extended rally. Okay, although the market has hit equality, okay, somewhere around here, but I think it is going to extend higher beyond 27,424, perhaps to even challenge 31,100. So the upward momentum remains very much in place. Okay, we have what appears to be an incomplete three-way pullback. Okay, not quite complete. What I would consider it to be an incomplete three-way pullback here. So, are we going to see a complete pullback? It is still possible, yeah, especially if the market loses a little bit to go below 24,900. This is the day time frame. Three-wave is incomplete. If it's a three-way equality move, there's a possibility of a 24,700 points here. If the market do collapse, not collapse, continue to decline. And even with that, that does not change or even compromise the overall bull market scenario. Okay, so in the market no pullback, there could be a buying opportunity for Hong Kong. I won't be selling this, that's for sure. Okay. So now we have finished equity market as a whole. Okay, I think there's a question here. Jim is asking, with the Fed ending quantitative tightening, do I foresee that the US bond yield will fall? The market has not shown that to be the case. Okay, the expectation of interest rate cuts followed by the ending of quantitative tightening has not seen bond yields collapsing or coming down. In fact, it is the exact opposite. So the bond market is pricing in not so much on the prospect of the end of quantitative tightening. Okay, they are looking into further rate cuts going into 2026. And from what we can see from the U.S. Treasury bill yield, it seems that they are betting that further rate cuts may not be something that we can take to the bank, okay, just yet. Now, David is asking what is the possibility of BOJ increase interest rate very high, okay, because Japanese JGB yields are already trading at record high. So the market has already priced in, okay, higher interest rates. Okay, so the possibility of BOJ actually increasing interest rate is already there. Okay, we don't have to wait too long. Like I say, we only wait for a fortnight. We will be able to see the result. But first, we have to clear through this week first. Okay, based on the FOMC meeting. Okay, hopefully I've answered your question, both of you. If that's the case, let's go on and look at currencies. Okay. In terms of currency, let's take a look at the dollar index. We can see a little bit of a rebound in the dollar index, but only marginal. This is the weekly time frame of the dollar index. Now, the dollar index is basically an index of a basket of currency for US major trading partners. Okay, of course, the biggest currency in this basket is the euro. So we can see that the dollar index, okay, if this dollar index is showing the price are coming down, that means the dollar is coming down. And we already knew since January of this year, since the inauguration of President Trump as the 47th US president, the dollar has been coming down in double digit. At the lowest point, it lost about 11%, okay, against all major currencies. So we can see the dollar index is reflecting this possibility, and it looks like a three-wave equality move should see another dip below 96 towards 94.7. So it is still possible we continue to see a lower dollar going forward. Perhaps for all we know, if this past 2 week weakness in the dollar accelerate to the downside, we could possibly see a revisit of the 96 level towards 94.7. But once this level is hit, be very careful. I do suspect that the dollar may not be that weak going into 2026. Okay, so I am actually long-term bullish on the dollar relative to the other principal currencies. Okay, the dollar index on the daily time frame is showing that this is still predominantly favoring the downside. Okay, so this week we can see that the dollar index has managed to climb just marginally above 100 and now is back at 99. It's at 98 now, right now. Okay, where we are seeing now is at 98.4. Okay, so we can see that the dollar has slipped again. Will this slip continue to extend lower below 96? Possible. Okay, especially if 97.4 is taken out. So getting forward, if you are into currencies, there's a possibility we will see extended weakness in the dollar. Euro dollar remains well bid. Okay, I have always been bearish on the euro dollar. So we can see what we see in the dollar index. This is a mirror image of what we see in the dollar index. Like I said, this basket of currencies is heavily skewed towards the euro. So this is basically a reverse image of what we see in the dollar index. We have a three-wave rally, but unlike the dollar index, the euro has hit equality at 1.1917. So the high traded this year is 1.1919. So there is the marginal, it's basically hit its bare minimum requirement. So if that's the case, it's logical to expect the euro dollar to continue to weaken. And because overall, you can see that the euro dollar is actually in a bear market. Okay, you can see this is actually in a bear market. So for us, for me, I have always been looking for selling opportunity. But because the dollar index has not technically hit the ideal classical three-wave pullback, I think that there will be a bit of a struggle going forward. Although any kind of signal to tell me that euro has seen its top will definitely be very conducive for me to position long-term selling all principal currency against the dollar. Okay, so I do believe the euro uh, is inherently weak. Now, we also know for a fact that the EU has been trying to push through what we call a reparation loan using Russia frozen reserve. Now, the stumbling block comes from Euroclear, which is the custodian for the trading of euros. Basically, the Euroclear, which is their clearinghouse and custodian. Okay, so if the EU force the Euroclear to agree to allow them to take whatever that's frozen in the Euroclear system, Russia frozen assets, and give it to Ukraine, okay, that itself is a negative for the euro because trust is what holds financial system together. So if Euroclear allows the EU to strong arm them to agree to allow the EU to take those money frozen in the Euroclear system and give it to the Ukrainian, that trust will be broken. And if trust is gone, uh, other countries that uses the Euroclear system will decided that the euro monetary system is no longer neutral. They may do what they do to the dollar, called the de-dollarization. Then, if that happens, there could be a de-euroization for all we know. Okay, and the ECB is not buying that narrative as well. The ECB, together with Euroclear, is telling the EU it is not the smartest of moves, but because EU has run out of money, they need to support the war in Ukraine, so they think that it is convenient. They come up with very clever legal language to say that we are not taking those money. We are basically taking it in advance. Okay, the assumption here is that Ukraine will win the war and Russia will have to pay reparation. Okay, so what if Ukraine don't win and Russia actually win? And this is the problem for Euroclear if they okay the EU pressure to release those money. Okay, so if Euroclear agree to release those money, the euro dollar, the euro itself, the currency will most likely, in my opinion, see a massive sell-off. Okay, so that will be another negative for the euro currency. Okay, in the daily time frame, you can see that there is three-way pullback, okay, on the lower time frame, which is the daily time frame, which is incomplete in my opinion. We probably will see further decay in the euro on the daily time frame on a technical basis towards 1.1370. Okay, so this also support the fact because right now the price is just under the cloud. Okay, this is a Ichimoku cloud, and this acts as a resistance. And if we do see weakness in the coming days, it is very highly possible that we may see a rapid unraveling of this euro towards 1.13. Okay, so that will be something to watch. Now, the other currency to watch will be the sterling. Now, sterling does not quite have the same pattern as the euro dollar. Okay, so we can see that the sterling has also been elevated. The rebound from 1.03 half to 1.1390 has been ongoing, but now we can see that it's a little bit of loss of momentum. We have a three-way pullback on the weekly time frame, which theoretically should end this pullback and get this currency pair ready for a challenge of this high here at 137.90. Okay, this is at least a technical possibility here. Okay, this is a three-way pullback. The market hit equality at 1.3, and now we can see that the market is going back up. On the daily time frame, the price action right now is still under the cloud. Okay, if it closes above the cloud, it would signal that the market is going to go for this level at 1.1390, 137.90. Okay, but again, if the euro is expected to be weakened, then buying the sterling may not necessarily be a good idea also. Now, dollar yen is going to be the currency pair to watch going into the next 2 weeks, okay? Purely because of the BOJ possibility of hiking interest rate. But immediately, if the US Federal Reserve actually cut rate, it will actually favor the dollar yen higher. But you notice that the previous high here is 162. Now, that happens in 2023. Now, remember what happened then? There was a big sell-off here caused by the Bank of Japan and the Japanese Finance Ministry intervening in the currency market by selling the dollar for a yen, which brought the dollar yen from 162 down to 139 half, which is a massive move. Okay, and again, this wasn't a perfect three-way pullback because theoretically, if this is a classical pullback, it would actually see dollar yen continue to trade lower below 139 towards 136. Okay, but it did not happen. The last time it actually attempted to break, it failed at one just under, just above 139.90. Okay, so now the price has been trading higher. So if dollar yen continue to trade high, meaning to say the yen is losing value, will it prompt another intervention by the Bank of Japan? Okay, possible, because any kind of weakness in the yen means it will show up in inflation domestically. Okay, because Japan imports a lot of energy products. Okay, it also imports a lot of other stuff. Okay, so a weaker yen is definitely going to cause those imports to be more expensive, and it may actually lead the Bank of Japan to actually physically intervene in the markets to make sure the yen do not decline too fast. Okay, so this 162 is the line in the sand. Okay, if the market go up and test this level, there is always the risk of a currency intervention. Okay, daily time frame, you can see that the market right now is actually quite bullish. We do have a counter trend in place. Okay, for 157.90. Okay, the lowest traded is just above 154.30. Okay, so this is a very minor one. Technically speaking, it does look like this is a market to buy, meaning to say if the dollar yen continue to trade lower and if it touches the bottom of the cloud here, then there could be buying interest re-emerging. And technically speaking, everything points to further loss in the yen value. Okay, right. Any other currency that you want to watch, which I have not already shown you? Because I don't want to spend too much time on currency if I can avoid it. All right, I want to go into precious metals. Okay, here we have gold prices on a spot basis. We have seen the all-time high at 4,381. Okay, the market did have a pullback to test the 3,900 levels, and now we see a bit of a bounce. Okay, is this over? The million-dollar question is gold getting ready to reclaim the all-time high? Okay, so we have likely to see increased volatility this particular month in December. Okay, here we have a rebound from $3,886 to as high as 4,264 and a half. And it does look like the possibility of another dip cannot be ruled out. Okay, if it does dip, it will complete this technical pullback in a three-way structure, possibly targeting anywhere between 3,750 to $3,770. Okay, that would be perfect. Long term, this is a lower to buy market. Okay, so if you are not sure, okay, you should only be looking for buying signal and avoid trying to sell this potential dip. Okay, that will be very, very dangerous to be selling into a very, very strong bull market. Okay, so on a lower time frame, you can see that this build up from 3,886 is actually very corrective. Okay, can we see further gain? Possible, but once the price action goes below the cloud, I think it will signal perhaps another attempt to take out this low here at 3,886 towards 3,700 thereabout. Okay, so this is a market with the potential to actually complete this three-way pullback, but overall it is still a bull market. Okay. Now, the other one I am going to show you is the silver market. Now, this week we have fresh all-time high traded in silver. Now, gold did not have all-time high. Okay, the fundamentals between gold and silver is a little bit different. We have very severe shortages and tightness in the spot market, leading to the idea that the silver has a lot more to offer. Okay, the high traded this week itself is $59.32 per ounce, which is an all-time high. Okay, I'm already long this market, so I'm just hoping to see more gains ahead. So this is the daily time frame. We can see that we have a marginal high before the market pulls back. Okay, which is not very healthy. But I think the tightness in the actual spot market may actually see further escalation in the silver market. Okay, so between silver and gold, I do believe going into 2026, silver will continue to outperform gold. Okay. Now, in the crude oil market, earlier on, I did note that the WTI can actually increased by 2% this week itself. You don't see it very much on the weekly time frame because the weekly time frame is still telling us that crude oil prices have some way to go before it finds its bottom. Okay, but I'm really gone long. Hopefully this trade will work out for me, and because there is a counter trend in place with a very deep retracement here, so technically my risk reward is actually superior if I go and buy rather than sell. Okay, so in the daily time frame, you can see that the price is still very much below the cloud. I need price to go up and close above the cloud. That will be another confirmation that we have seen the low for this round. Okay, and even that's the case, it could still work out to be a simple three-way bounce into $62 or $64, okay, between the area. And if you cannot hold, you can still see lower prices. But I'm going to protect my long positions going forward. Probably will tighten my stop going forward. So we have finished looking at the crude oil. Now let's take a look at Bitcoin. Bitcoin has been in the picture. A lot of people are saying that Bitcoin has found its bottom. Okay, we do not know for sure. So this is the monthly time frame for Bitcoin. Now, I've always mentioned even if Bitcoin go down to 16,000, it is still a bull market. Ideally, it doesn't go below 50,000, okay? But if it does go down that low, it's technically still a bull market, okay? So long-term bull market is still not damaged. We have in the weekly time frame, Bitcoin falling to as low as 84,000 on this platform. For other exchanges, the low was above 88,000. So we can see the price is not in the cloud itself. So there is no confirmation that it will go lower. Okay. But if it does go lower, it could continue to slide lower towards this 40, towards the 50,000 levels. Okay. So is it a good price to go in to buy right now? I am not convinced that the bounce that we see this past week is the result of fresh buying interest. I think it's more like short covering. People who have previously sold now are covering the position. So we can see that the recovery is not aggressive in any way. Okay, so the fact that it has actually hit a bottom at 80,500 shows that this is a very deep retracement without compromising the overall bull market, and further gain will be kept by the cloud here. Okay, so again, watch out for further weakness going forward, because right now we have one, two, three. This three wave looks to be very extended. So long as it doesn't go back above 102,000, there's a possibility this will end up as a five wave. Five wave means one, two, three, four, five wave below the 80,500. Okay, so the level to watch will be this level, 74,400. A lot of charts is pointing towards once this level, 74,400, cannot hold, it could dramatically change the outlook for Bitcoin on the daily time frame onwards. Okay, so be aware that any kind of bounce, we will need to see how market performs. It ideally do not overlap 102,200. And if it does show weakness, especially if it touches the bottom of this cloud here and start to come back off, then of course we have to look into the possibility of a revisit of this low here, okay, towards 74,400. So this is Bitcoin. All right, guys, I have covered all the major markets that I want to talk about, unless you have something else you want me to cover. Anything else? No question? If there's no question, I am leading to ending this session here. All right, guys, thank you very much for your time. I shall see you next Sunday. Bye bye, and have a great week ahead.